Welcome to this explainer. Okay, so today we're tackling something that keeps a lot of us up at night. How do you actually secure your family's future without going completely broke right now? It's a tough balancing act, but let's just dive right in.
And that brings us to a pretty provocative question. Is your life insurance actually pushing you into a debt trap? I know, it sounds totally counterintuitive. I mean, it's supposed to be a safety net, right? But the crazy thing is, the very product meant to protect your family might secretly be destroying your monthly cash flow. Let's break down exactly how this happens.
To make this super concrete, let's just anchor our strategy to a very common baseline, 1 lakh rupees. If you're a salaried professional pulling in around a lakh a month, you've got a young family, maybe a hefty home loan hanging over your head, well, this math is absolutely going to change how you view your money.
Before we start running the numbers, we kind of need to remind ourselves what insurance actually is at its core. Think of it like a parachute, not an airplane. Its real, true purpose is pure protection. We're talking about replacing your income, wiping out that massive home loan, and just making sure your kids' education and your spouse's future are totally secure if the absolute worst happens. It is emphatically not some get-rich-quick scheme.
So, right off the bat, how much protection do you actually need? Well, financial planners use this fantastic no-nonsense baseline called the 10-20-X rule. And it's exactly what it sounds like. Basically, to make sure your family maintains their current lifestyle, your life cover really should be anywhere from 10 to 20 times your annual income. Just guessing a random number? Yeah, that just doesn't work here.
Now, let's apply that rule. If you're earning, say, 12 lakhs a year, doing the math lands us at roughly 1.5 to 2 crore rupees. Just think about that for a second. 12 lakhs times 15 years gets you to 1.8 crores pretty easily. That is the actual cover you need to genuinely protect a family against things like 7% inflation, those skyrocketing education costs we all hate, and long-term debt. I know, a couple of crores sounds massive, but hey, the math doesn't lie.
But here is where we see the sheer danger most folks are in right now. On one end, you've got that ideal 2 crore cover we just talked about. But on the other end, the typical policy most people actually buy is a mere 50 lakhs. They are walking around so incredibly underinsured, it's scary. It literally leaves this massive, dangerous gap in their family's financial safety net.
And you know what? That huge gap usually comes from trying to kill two birds with one stone. It's what happens when people mix insurance with savings. It's honestly like buying a Swiss Army knife, when what you actually need is a heavy-duty sledgehammer. We get heavily marketed into buying these really expensive pension or children's education plans. They promise you a big payout way down the line, but the reality? They end up locking you into these massive, suffocating monthly commitments right now.
And the cash flow strain from that, it is immediate. Sinking 15 to 30,000 rupees a month into these traditional plans means literally up to 30% of a 1 lakh income vanishes. Boof, straight into premiums. What does that leave you with? You're left scrambling to cover your daily life and those heavy EMIs with just the leftovers. And that is exactly what forces so many families into taking out high-interest personal loans just to survive an unexpected emergency.
When you really look at the alternatives side by side, the math for those traditional plans just totally falls apart. Let's look at a pure term plan. It has a remarkably low premium, but it actually gives you that massive high 2 crore cover. Traditional plans, they do the exact opposite. They demand incredibly high premiums for desperately low cover, and on top of that, the returns barely even beat inflation.
So it basically boils down to the super dangerous paradox. Those high premiums are eating up 20 to 30% of your income, day in and day out, basically creating a debt trap. And yet, and this is the crazy part, you're still left with completely inadequate cover. Your money is completely tied up, and your family, they're still vulnerable.
All right, so what's the fix? The secret here is to just totally avoid that old trap of bundled endowment or ULIPs. You know, those super complex unit-linked insurance plans? Just skip them entirely. The smart way to do this? Unbundle them. Buy a pure term insurance policy strictly for the protection aspect, and then use separate automated mutual fund SIPs for your actual wealth creation. Decoupling those two goals is exactly how you win this game.
And why is unbundling such a game changer? Well, because a pure term plan actually secures that massive 2 crore cover for roughly, 1,000 to 2,500 rupees a month. Literally, for the cost of maybe 1 or 2 family pizza nights, you completely protect your family's future. And you instantly eliminate all that crazy cash flow strain we were talking about earlier.
Plus, doing it this way naturally aligns you with a really smart budget rule.
By unbundling, your total insurance and your investment premiums combined stay strictly under 15% of your income. And that is huge because it frees up your cash flow. It leaves you with a very comfortable 85% for your actual living expenses, clearing out your home loan, and, actually enjoying your life today.
So if you're ready to execute this, it's just a straightforward 3-step action plan. Step 1, sit down and objectively assess your family's real liabilities. Step 2, go buy a pure term insurance policy right now while you're young and healthy so you can lock in those incredibly low rates for life. And step 3, start your separate automated SIPs that are strictly dedicated to your specific life goals.
Now, real quick, before you go overhaul your finances, watch out for a couple of critical mistakes. Beyond the trap of those savings plus insurance combo plans, the absolute biggest danger is just delaying the purchase, or even worse, assuming your corporate group insurance is enough to cover you. Please remember, that company cover, it completely vanishes the minute you change jobs or if you face a sudden layoff. Do not rely solely on it.
All right, I'm going to leave you with this final thought to ponder as we wrap up this explainer. Ask yourself honestly, are you currently paying way too much for way too little cover? Or are you ready to truly secure your family's future? Take a hard look at your policy statements this week. Separate your insurance right out from your investments and build a real safety net, one that actually protects your family without draining your life today. Thanks so much for joining me.